Let's get into market voice. Ajay Bagga, market veteran, joins us right now on the show. Mr. Bagga, good afternoon. Thanks so much for joining in. I remember the last conversation, which a lot of people, of course, referred to of yours when you were in our studios, when you were talking about how a few things that needed to be set right are not getting set right, and therefore the markets will correct. There was an attempt made last Friday. The markets, though, after a couple of days of a rally, are coming off. Needless to say, looking at the economic worries as well. What's your sense now at 11,000? Is there more risk than reward, or is it the other way around?
I think more risk. That's very clear, and we are looking at the quarter that's gone by. Neeraj, we'll have the numbers on Friday. We're looking at 5.5 to 5.7 kind of GDP growth. For the present quarter, which is ongoing July to September, we are not looking at much of a recovery, and that's what's spooking the market. So one is the policy stimulus, both monetary and fiscal, that has been slow. It was a good thing that the Friday action happened from the government, but a lot more broad-based fiscal stimulus will be required if we want to take the economy back to the 7.5–8% levels. Otherwise, this year is looking like a 6% level. Already you are seeing the rating agencies bringing down the numbers to 6.2, 6.3, as against the RBI's number of 6.9, which they gave out in their August policy. So there are downside risks. The economy has slowed down. Consumption, which is the key driver in India, is slowing down, and for that you need a pump priming of the economy, which comes through a fiscal stimulus or monetary stimulus. Both have been very muted so far. So we will look forward to something more on that side, Neeraj.
You know, I will just go back to those flashes of Yes Bank as well, and it just brings into point something that we want to talk to Mr. Bagga as well, but it just brings forth in the point that I think in the morning the conversation was that it might pay to make sure that your portfolio doesn't have some of the banks on which the outlook seems to be very uncertain. RBL is a case in point for that, because the asset quality might just be veering. But Yes Bank, and that's the big news, that Moody's has cut the ratings on Yes Bank. The outlook has been shifted to negative. Maybe that's one reason, or otherwise, but Moody's, Yes Bank certainly correcting quite strongly in the session today. Look at the volumes there, 168 million shares. Is not abnormal for Yes Bank to trade so much, but it is high compared to the averages, I reckon, and 9% down currently. Mr. Bagga, more risk than reward. What about these banks wherein Yes Bank, wherein we know that there is a bit of an uncertainty, or RBL, wherein the management has stated that the asset quality might have some issues? What do you do out here in this pocket?
I think stay away. Stay away is the only way out. You have to stick to quality. So, for quite some time, Neeraj, I've been saying no more fresh investments. Conserve capital now, you will get lower levels. And definitely in these troubled pockets, I think we should not be fishing there. We have to give it time for the managements to engineer turnarounds. Don't be too early in it. Of course, the smart money bought in at 83, 89 into the QIP, and even in when they were asked about it, nobody is commenting really. So. There you have it. So at times, the smart money might be a little early than what the market is showing up. But maybe on a 2-year, 3-year horizon, it might turn out to be a good bet. But right now, for the retail investors, I would say better to stay cautious, conserve your capital. That's what the whole economy is doing. People have gone slow in purchases. Same way for the markets also. This is not the time to go in and start buying in a sale. You will get better prices. That's my thinking.
The other one, Ajay, is RBL Bank, and the stock price is just not finding a bottom currently. What would you say could be the problem that lies here? Is it similar? If you've been hearing anything with regards to asset quality issues becoming an issue for this bank as well?
It's asset quality plus, there are street rumors about some sales by management. So we'll have to see, what comes out. Right now, the markets are very skittish. So people are just pressing in sales at any whiff of a rumor. Excellent management. I've known a lot of them for a very long time. I've worked with some of them. Expectations were very high. But we'll have to wait and see. There was a guidance last week on asset quality issues. We'll have to wait and see for the next quarter's results. But clearly, the market is in no mood to be generous on any stumble as far as performance goes. That's what's showing up. So we'll have to wait and see. I don't have more information, but a lot of rumors abounding in the market, and that's what's causing this kind of a sharp sell-off in the stock.
Well, it was the management commentary after the first quarter numbers which spooked the markets and the investing community, especially the shareholders. And since then, we've seen the stock price correcting. And I think the major takeaway from the commentary was they highlighted that the credit cost can increase by 35 to 40 bips for RBL Bank, which is a pretty high number. And the reason for that was because of their stress that they have seen in the large corporate accounts, and which could likely push up their gross NPAs to about 2.25 to almost 2.5%, which the management highlighted. But let's see, we'll have to wait and watch. And of course, there are other rumors also on the street. There could be some selling coming about. Besides, the banking space, Mr. Bagga, I'm just going back to what Neeraj asked, the sort of measures that have been announced first by the FM on Friday. Then we had some, second booster shot coming in from RBI, where the government is getting some additional 52,000 crore. Do you think now, to revive the animal spirits, does the economy needs a stimulus, or there can be some passive measures also being announced by the government, like in the way they announced for autos? Is that enough?
Not enough. Auto, you need radical surgery like you did in 2008, where overnight the excise duties were cut. You have to bring down the cost of ownership and help people buy more autos. Second big thing is we've done the first anniversary of ILFS. We are nowhere near any kind of resolution. Even the good assets have not been sold so far. It's been too slow. Unlike what was undertaken after the Satyam issue, where the government moved very fast, and including the infrastructure assets were safeguarded and the market was safeguarded. Unfortunately, in the ILFS case, the NBFC issue has spread, contagion has spread, and today NBFCs, despite being nearly 23% of the country's credit, don't have funding to keep on growing. We have seen a year-on-year decline of 30% in the growth rate of NBFCs, and that's what's holding back the economy, holding back the two-wheelers, tractor segments, because a lot of these were based on funding from NBFCs, and the banks have not really been able to step in and take on that workload. So auto is a combination of reducing the cost of ownership, giving some benefits to the industry to help it tide over this tough part, and secondly, making it easier for the consumer by creating better financing and easier financing at a lower cost. I think that's what auto needs. Scrappage, all these are good policies. Estimates are showing that there are millions of vehicles which are more than 15 years old, so there will be a boost. But will people have the money to really replace immediately? Autos in India are not viewed as a 10-year, 15-year auto. You keep selling and they keep going to tier 1, tier 2, tier 3 towns, then villages, and keep getting used much beyond their 15-year life. So we'll have to wait and watch, but at least it's positive. All the steps taken were positive, but much more will be required.
I guess so. Mr. Bagga, take a moment to thank you for joining in today and, calling a spade a spade. Let's see how the next few days shape up. That's Mr. Ajay Bagga with his thoughts, market veteran, and talking about why maybe there's more risk than reward if you want to bet on the markets right now.